If millions of people have been priced out of the housing market, why haven't home prices crashed? Seriously, think about it. Home affordability is near some of the worst levels in decades. Mortgage payments have surged. Sales activity has slowed. First time buyers are struggling to qualify. And yet, in many parts of the country, home prices are still hovering near record highs. That shouldn't happen. We're constantly told that when demand falls, prices follow. It's one of the most basic rules of any market. So, why does housing seem to be playing by different rules? Maybe you felt this yourself. Maybe you've spent months saving for a down payment only to watch prices move even higher. Maybe you've been outbid repeatedly. Or maybe you're looking at homes today and wondering how families are supposed to make the numbers work anymore. And here's the strange part. Some of the explanations people repeat most often may not be the real reason prices remain so high. Before we go any further, welcome to Gray Finance. I'm Gray, and on this channel, we break down the biggest stories in housing, taxes, investing, retirement, and personal finance, without the headlines, politics, or noise that usually get in the way. Because the deeper I looked into this story, the more I realized that what seems like a simple housing problem is actually a puzzle with pieces most people never see. Some of those pieces are obvious, others are hiding in plain sight. And when you put them together, they start to explain why so many Americans feel like home ownership is getting further away no matter how hard they work to catch up. So, let's start with one of the most controversial questions in the entire housing debate. Are corporations and large investors influencing the market far more than most people realize? Or are they simply being used as a convenient scapegoat for a much bigger problem? So, are corporations really buying up all the homes? It's one of the most common explanations for the housing crisis, and honestly, it's easy to see why people believe it. Imagine spending months searching for your first home, finally finding one you can afford, and then losing it to an all-cash offer from an investment company. For many buyers, that's not a hypothetical scenario. It's something they've experienced firsthand. And stories like that have helped create a powerful narrative. Wall Street is buying America. But when you dig into the data, the story becomes much more complicated. Here's the surprising part. Despite years of headlines about institutional investors flooding the housing market, they still own only a relatively small share of America's total housing stock. That's important because if corporations were the primary reason housing had become unaffordable everywhere, you'd expect them to control a much larger portion of the market. So, does that mean investors don't matter? Not at all, because housing isn't one national market, it's thousands of local markets. And in some cities, investors have concentrated their buying in exactly the places where inventory was already limited and competition was already intense. In those areas, even a modest number of investor purchases can make it harder for families to compete. But here's the key point. Investors may be part of the story, yet they're probably not big enough to explain the entire crisis. And that's where things get interesting. Because even if every institutional investor stopped buying homes tomorrow, millions of properties would still remain out of reach for traditional buyers. The real question is why? Where are those homes? Because some aren't being bought by families. Some aren't being bought by corporations either. Instead, they're being pulled into an entirely different system, one that has quietly transformed housing from a place to live into something else entirely. So, where are these homes going? One answer may be hiding in plain sight. Imagine two identical houses sitting on the same street. One is rented to a local family for the next 5 years. The other is rented to a different group of visitors every weekend. Which one do you think generates more income? For many property owners, the answer has become increasingly obvious, and that simple financial reality may have changed the housing market more than most people realize. Over the last decade, short-term rental platforms have made it easier than ever for homeowners and investors to turn residential properties into income-producing assets. A house that was once part of the long-term housing supply can suddenly become a vacation rental, a weekend getaway, or a temporary stay for travelers. At first, that might not sound like a major issue. After all, what's the difference if a home is still being occupied? But that's exactly where things get interesting. Because from the perspective of a family trying to buy a home or even rent one long term, that property has effectively disappeared from the traditional housing market. It's no longer competing to house local residents, it's competing to generate the highest possible return. And in some of the most desirable destinations, that shift has been significant enough to reshape entire neighborhoods. Homes that might once have been occupied by year-round residents are now part of a completely different economy. Suddenly, a house isn't just a place to live, it's a business. And when housing becomes a business, the incentives begin to change. The goal is no longer necessarily to provide a home for the next family. The goal becomes maximizing revenue. In some markets, that can make short-term rentals more attractive than traditional leasing, encouraging more properties to move in the same direction. But here's the question that made this issue so controversial. If short-term rentals are reducing the number of homes available to local residents, could they be a major reason housing has become so unaffordable? Not so fast. Because just like institutional investors, the numbers tell a more complicated story. In some cities and tourist-heavy markets, short-term rentals may have had a meaningful impact on housing availability, but across the country as a whole, they still don't appear large enough to fully explain why affordability has deteriorated almost everywhere, which creates an even bigger mystery. We've looked at investors, we've looked at short-term rentals, and yet there are still millions of homes that seem to exist outside the traditional housing market. Some aren't occupied by families, some aren't vacation rentals, some aren't even being used at all. So if America supposedly has a housing shortage, why are millions of homes reported as vacant? At this point, the housing crisis starts to feel almost impossible to explain. We've looked at investors, we've looked at short-term rentals, and yet one statistic keeps appearing in housing debates over and over again. Millions of homes across America are reported as vacant. So naturally, people ask a simple question. If there's a housing shortage, why are so many homes sitting empty? At first glance, it sounds like the ultimate contradiction. In fact, if you've ever seen headlines about millions of vacant homes, you may have had the same reaction many people do. Wait a second. If all of those homes were available, wouldn't the housing shortage disappear? But this is where the story takes an unexpected turn. Because when most people hear the phrase vacant home, they imagine something very specific. They picture a perfectly livable house sitting abandoned for no reason while families struggle to find affordable housing. The reality is far more complicated. Some vacant homes are between owners, some are waiting for new tenants, some are undergoing repairs. Others are vacation properties that sit empty for much of the year, and some are simply located in places where demand has been declining for years. In other words, many vacant homes aren't truly available housing in the way people often imagine. And that's a crucial distinction, because a vacant cabin in a remote area doesn't help a family searching for a home near jobs, schools, and growing cities. A property undergoing major repairs can't immediately absorb housing demand. And a seasonal vacation home isn't likely to enter the market simply because affordability has become a problem elsewhere. So does that mean the vacant homes argument is completely wrong? Not exactly, because buried inside those vacancy numbers is another uncomfortable reality. Some homes are being held as investments, some remain unused for long periods of time. and some exist in markets where housing has increasingly become a store of wealth rather than simply a place to live. That doesn't mean vacant homes are large enough to solve the entire housing crisis, but it does reveal something important about how housing is changing. More and more, homes are serving multiple purposes at the same time. They're places to live, they're investments, they're income producing assets, they're retirement strategies, and sometimes they're simply wealth preservation tools. The problem is that when a single asset has so many competing uses, people looking for a place to live aren't always competing against other families anymore. They're competing against entirely different motivations. But even after investors, short-term rentals, and vacant properties, we're still left with a major unanswered question. Because maybe the issue isn't just what's happening to housing, maybe it's what's happening to people. After all, if homes have become more expensive, that doesn't automatically create a crisis. A crisis emerges when incomes can no longer keep up. And that raises what may be the most important question in this entire investigation. Have houses become too expensive? Or have wages simply failed to keep pace with the cost of home ownership? At this point, we've examined several forces that may be reducing housing availability. Investors, short-term rentals, vacant properties. But what if we've been looking at only half of the equation? Because a housing crisis isn't created by home prices alone. It's created when home prices and income stop moving together. And that raises a question that cuts straight to the heart of the affordability debate. Are houses actually too expensive? Or have wages simply failed to keep up? At first, that might sound like the same thing, but they're not. Imagine two people separated by 40 years. The first person buys a home decades ago. Their salary isn't extraordinary. They aren't wealthy. They don't have a six-figure income. Yet the cost of the home is only a few times larger than what they earn in a year. Now imagine someone today. They may have a better education, a higher salary, a stronger resume. They may be earning more money than the previous generation ever did. And yet they still can't afford the same kind of home. How is that possible? This is where the affordability crisis becomes impossible to ignore. Because when economists compare home prices to incomes over time, they often find that housing has become increasingly disconnected from what ordinary households earn. In many markets, home values have risen far faster than wages, creating a growing gap between what people make and what homes cost. And that's the part many buyers feel every day. Not because they can't find a job, not because they aren't working hard, but because the financial target keeps moving faster than they can run. A family spends years saving for a down payment. During that time, prices rise. They finally increase their income. Mortgage costs rise. They save more money. Ownership expenses rise. The closer they get to the goal, the further away it sometimes feels. And that creates something much more powerful than a supply problem. It creates a perception problem. Because millions of people are doing what previous generations were told to do, yet the outcome often looks completely different. That's one reason the housing conversation has become so emotional. People aren't just comparing themselves to the market, they're comparing themselves to the experiences of their parents, coworkers, neighbors, and older generations who seem to have entered the market under very different conditions. But before we assume this is simply a story of rising home prices, there's another detail that's easy to miss. Because buying a house is only the beginning. Many people focus on the mortgage payment when calculating affordability. What they don't realize is that some of the fastest growing housing costs arrive after the purchase. And for many homeowners, those costs have become a second affordability crisis hiding beneath the first. For many people, the hardest part of home ownership is supposed to be getting the house, saving the down payment, qualifying for the mortgage, winning the bidding war. That's a challenge everyone talks about. That's something more homeowners have started talking about in recent years, especially in areas where housing costs have risen rapidly because one of the biggest surprises facing homeowners today is that some of the fastest growing housing costs arrive after the purchase. And unlike your mortgage payment, many of those costs don't stay fixed. Take property taxes. Most buyers spend months calculating what they can afford. They analyze mortgage rates, compare monthly payments, and stretch their budgets to make the numbers work. What many don't fully appreciate is that the same rising home values making headlines can sometimes come back later in a very different form. Imagine finally buying a home after years of saving. A few years pass. The neighborhood becomes more desirable. Home values climb. And to be fair, in many ways, it is. Most homeowners would rather see their property's value increase than decrease. You're wealthier than before. Your home's value has increased, you've built equity. So why do some homeowners feel more financially stressed than they did when they first bought the house? Because appreciation doesn't only affect wealth, it can affect costs too. In some communities, higher property values can eventually lead to higher tax assessments. And while homeowners may celebrate rising prices when they look at their home's value, they don't always celebrate the bill that can follow. The very thing that makes people feel wealthier can sometimes create new financial pressure at the same time. The same force making homeowners richer on paper can make them feel poorer month to month. And for retirees, fixed income households, or families already operating close to their financial limits, that contradiction can become a serious problem. But here's the part that's easy to miss. Property taxes aren't really the story. They're the warning sign because they reveal a larger shift taking place beneath the surface of home ownership. The housing crisis isn't just about getting into the market anymore. It's about staying comfortable once you're there. And if rising property taxes are creating pressure, there's another expense that's become even more unpredictable in some parts of the country. An expense that, for some homeowners, has been increasing far faster than they ever expected. Home insurance. By now, we've uncovered a pattern. The housing crisis isn't just making it harder to buy a home, it's making it more expensive to keep one. And few examples illustrate that better than what's happening with home insurance. For decades, insurance was something most homeowners barely thought about. You bought a policy, paid the premium, renewed it each year, and moved on with your life. It wasn't exciting, it wasn't controversial, and it certainly wasn't one of the biggest topics in housing. If you live in certain parts of the country, there's a good chance you've either experienced this yourself or know someone who has. Because in some parts of the country, homeowners aren't just dealing with higher insurance costs, they're dealing with something far more unsettling: uncertainty. Imagine receiving a renewal notice and discovering that your premium has increased dramatically. Not because you filed multiple claims, not because you changed your coverage, but because the risk around your property have changed. And for many homeowners, that's frustrating because it's an expense they have very little control over. And that's where this story starts to get interesting, because insurance companies aren't pricing homes based on what happened yesterday. They're pricing them based on what they believe could happen tomorrow. Flood risks, wildfire risks, storm risks, rebuilding costs, the probability of future losses. All of these factors influence how insurers evaluate a property. And in some areas, those calculations are changing fast, which creates a strange new reality for homeowners. A family may have the income to afford their mortgage. They may have enough savings. They may even have substantial equity in their home. And yet one of the biggest threats to affordability isn't the house itself. It's the cost of protecting it. But here's the question that makes this issue so important. If insurance costs are rising because risk is rising, what happens to housing affordability over the next decade? Because unlike mortgage rates, which move up and down in cycles, some of these pressures aren't easily reversed. And that's beginning to affect more than just monthly budgets. It's starting to influence where people want to live, where builders want to build, and how buyers evaluate entire regions. In other words, insurance is no longer just an insurance story, it's becoming a housing story. But even this doesn't fully explain why so many younger buyers feel locked out of the market. After all, rising taxes and insurance mostly affect people who already own homes. What about the people still trying to get in? Because when you look closely at who owns housing wealth today and who doesn't, you uncover another force quietly reshaping the market. A force that may have less to do with houses themselves and more to do with something families pass from one generation to the next. Opportunity. At first glance, the housing market looks like a competition between buyers. People save money, they apply for mortgages, they search for homes, and eventually someone wins. Simple. But what if some buyers are entering that competition with advantages that aren't immediately visible? Because one of the most important housing stories isn't about houses at all. It's about timing. Imagine two families trying to buy similar homes. Both work hard. Both earn decent incomes. Both have stable careers. On paper, they seem to be competing under the same rules. But then something happens. One family receives help with a down payment. Maybe it's a gift from parents. Maybe it's inherited wealth. Maybe it's equity from a previous property that has appreciated over decades. Suddenly, the competition changes. Not because one family worked harder, not because one family is smarter, but because one family is starting from a different position. And that's where the housing conversation becomes much bigger than supply, demand, taxes, or insurance. Because housing wealth has a unique characteristic. Once someone gets into the market and property values rise, that wealth can compound over time. Equity becomes a larger down payment for the next home. That home may appreciate too. Over decades, housing can become a powerful engine for wealth creation. But what happens to the people who never get on that first step? That's the question increasingly confronting younger buyers, because while existing homeowners may benefit from rising prices, aspiring homeowners often face the opposite experience. The higher prices climb, the larger the down payment becomes. The larger the down payment becomes, the longer it takes to save. And the longer it takes to save, the more time prices have to continue rising. It's a cycle that can feel almost impossible to escape. And this is where many people begin to notice something unsettling. The housing market doesn't just reward income, it often rewards existing ownership. That's an important distinction because when people talk about affordability, they often assume the challenge is earning more money. But for many households, the bigger challenge is accumulating enough assets to compete in the first place, which helps explain why two people with similar salaries can have completely different housing outcomes. One is trying to build wealth, the other may already be benefiting from wealth that was built years or even decades earlier. And over time, those differences can become larger, not smaller. But here's the question that ties everything together. If investors aren't the full explanation, if short-term rentals aren't the full explanation, if vacant homes aren't the full explanation, if taxes and insurance aren't the full explanation, and if the wealth gap is only part of the story, then why are prices still holding up? Why hasn't the market corrected itself? Because there's one final piece of this puzzle that connects almost everything we've discussed so far. A force so powerful that it may be preventing prices from falling even while affordability continues to deteriorate. Supply. At this point, the housing market almost feels like a paradox. Millions of people are struggling to afford homes. First-time buyers are delaying purchases. Monthly payments have surged. Affordability has deteriorated. And yet, in many areas, home prices remain remarkably resilient. Why? After everything we've explored, this may be the most important question in the entire investigation. Because if buyers are struggling, shouldn't prices be falling? Under normal circumstances, that's exactly what many people would expect. But housing isn't behaving like a normal market right now. And the reason may come down to something surprisingly simple. And once you see this, a lot of the housing market starts making more sense. Think about that for a moment. When most people hear the phrase housing shortage, they imagine a lack of houses. But in many cases, the immediate problem isn't just a shortage of homes, it's a shortage of homes available for sale. And those are not necessarily the same thing. Imagine you're a homeowner who bought several years ago when mortgage rates were much lower. You locked in a payment that today would be almost impossible to replicate on the same property. Now, ask yourself a question. For most Americans, that's a pretty difficult decision, especially when today's mortgage rates could dramatically increase the cost of the next home. For many homeowners, the answer is no. Selling the house doesn't just mean moving. It could mean replacing an affordable mortgage with a dramatically more expensive one. And that's created one of the strangest situations in modern housing. Millions of homeowners may want the flexibility to move, but financially, many feel incentivized to stay exactly where they are. The result? Fewer listings, less inventory, more competition for the homes that do reach the market. Because the issue isn't simply that demand disappeared, it's that supply never showed up in the way many people expected. Because prices don't depend only on how many buyers exist, they also depend on how many sellers exist. If both buyers and sellers disappear at the same time, prices don't necessarily collapse. Transactions slow down. The market freezes, and that's exactly what has happened in many places. Fewer people buying, fewer people selling, yet not enough supply reaching the market to create a major decline in prices. But here's where all the pieces begin connecting. Investors can reduce available inventory. Short-term rentals can reduce available inventory. Some vacant properties can reduce available inventory. Years of underbuilding can reduce available inventory. And homeowners staying put can reduce available inventory. Individually, none of these forces fully explain the crisis. Together, they create something much more powerful. A market where affordability keeps deteriorating, yet prices remain stubbornly elevated. Which brings us back to the question we started with. If fewer people can afford homes than they could a generation ago, why haven't prices crashed? Because affordability and prices are not the same thing. A market can become less affordable without becoming significantly cheaper. And that may be one of the most misunderstood realities in housing today. But if that's true, what happens next? Because understanding why prices haven't fallen is one thing. Understanding where the housing market goes from here is another question entirely. And perhaps that's the biggest lesson in all of this. At the beginning of this investigation, we asked a simple question. If millions of people are struggling to afford homes, why haven't prices crashed? After exploring investors, short-term rentals, vacant homes, rising ownership costs, wealth gaps, and supply shortages, the answer turns out to be far more complicated than most headlines suggest. Because the housing crisis was never really about a single cause. It was about multiple forces pushing against each other at the same time. And that's why so many people feel confused. That's one reason housing debates can become so frustrating. Simple explanations are easy to understand, but housing rarely behaves in simple ways. But maybe the most important discovery isn't why prices remain high. Maybe it's what affordability actually means. For generations, home ownership was viewed as one of the clearest paths to financial security. It wasn't just a house, it was stability, opportunity, a foundation for the future. If you've spent the last few years watching prices climb while trying to save for a home, you probably don't need an economist to tell you something has changed, not because they aren't working, not because they aren't earning, not because they aren't trying, but because the relationship between income, housing, and opportunity has changed. And that may be the real story hiding beneath the housing crisis. In many ways, that's why this issue remains at the center of so many economic conversations across the country. The question was whether ordinary people could still build the kind of financial future that home ownership once represented. And until the question is answered, the housing debate is far from over. So, what do you think? Is home ownership still the American dream, or is it slowly becoming something fewer families can realistically achieve? And perhaps an even bigger question, if housing affordability continues to deteriorate, what does that mean for the next generation of Americans trying to build wealth? Have you been priced out of a home you thought you could afford? Or do you think the housing crisis is being exaggerated? Let me know where you stand in the comments below. I genuinely love to hear your perspective. And if you found this video valuable, make sure to hit the like button, subscribe, and turn on notifications. We break down the biggest stories in housing, personal finance, taxes, retirement, investing, and the economic forces shaping everyday life so you can better understand what's happening, what it means for your money, and how to stay ahead of the changes shaping the future. Thanks for watching. Stay informed, stay financially aware, and I'll see you in the next video.